me. I'm Patrick Camuso, the host of the Financial Frontier, and I'm delivering another impactful episode today that's packed with information on the latest regulatory changes as well as important issues and experiences that I'm having in my practice at Camuso CPA. I'm very excited to get into the headlines today. I'm going to start by sharing my screen. We'll go over a couple events and things that I want to bring into your attention. Then let's get right into the headlines. And then from there, we'll go over a few other points that I want to discuss as well. So let me share my screen here. Make sure I'm sharing the right screen. I believe I am. Let's see here. Okay, awesome. So first and foremost, I want to encourage everyone to visit our website at camusocpa.com and sign up for the Digital Asset Digest. This is our blog. It goes out usually on a weekly basis. Every now and then, if we, come into a tax deadline, it may revert to bi-weekly. But we try to get these updates to you every week, and the subscribership on this newsletter is growing very quickly, I believe, because of the quality of the content in it. So if you go to camusocpa.com under resources, you go right to this Web3 digital asset tax newsletter, and you could sign up for the digital asset digest. Right here, we're delivering valuable information to your inbox every week. So be sure to sign up for that. I really believe that you're going to benefit from it, especially if you like these lives and these podcasts here in the financial frontier. You'll really like the newsletter. We hit a lot of those topics plus much more. Secondly, if you go to Camuso CPA under resources, you can download the digital asset audit readiness guide. So I included a ton of information in here on digital asset accounting challenges, quality control, and due diligence issues, data security and freedom, how to safeguard your data, which is very important, misguided tax advice, and how to avoid tax traps. And there's much more in here. So visit our website to download this as well. This is another piece of information that can add a lot of value to you, whether you're self-managing your accounting and taxes, whether you have another CPA managing your accounting and taxes, or if you're a CFO or CPA yourself and you're looking to learn more about this space to better serve your clients. Next, we have the Web3 Tax and Accounting Essentials, what every Web3 CEO and CFO needs to know. This is going to be on December 7th. This is a webinar I'm hosting. You could go ahead and sign up for this over at LinkedIn. There's an event. The webinar itself will be hosted on GoToWebinar. We have well over 100 attendees at this event right now. And, it's about a month out still, so this will continue to grow. This is going to be a great event. We're going to cover a ton of information in here. So I encourage you to sign up for this as well. And then lastly, if you missed it, last week I hosted a crypto CPA Q&A, and after the feedback on this and the quality of this, we're definitely going to do more of these. In fact, I have another one scheduled for January where you give me questions, I answer them, even during the audio event itself. If you have questions, you can chime in and ask me the question live and I'll answer it, which some people did do. So if you want to catch the recording of this, you can go to my YouTube channel, just type in my name, Patrick Camuso, and you'll see this video along with hundreds of other videos that are packed with information posted on my channel. So be sure to check that out as well. So those are most of the items I wanted to show regarding, some of the events, some of the content that I'm putting out that I think can add value to you. So now let's get into some of the headlines. This first headline here: Oyster Protocol founder receives a 4-year sentence for tax evasion. So this is what I've been saying. We're going to start to see more headlines in the news about people having prison sentences and tax court cases and just overall tax controversy issues related to tax evasion. So This was for the Oyster Protocol founder, Amir Bruno, aka Bruno Block, was sentenced to 4 years for tax offenses exceeding 5.5 million. So this article was interesting because basically, they were looking at this guy for an ICO that he did. So as this article states, he conducted an ICO to sell Pearl tokens, intending to retain a founder share for personal use. He controlled the protocol through a shell company unassociated with his real name. So they said that these actions led to significant financial gains. But what's interesting is what they got him on, legally speaking, it appears, is his evasion of tax responsibilities eventually caught up with him, is what it says here. So basically, this guy had a lot of financial improprieties. He was mishandling funds associated with the ICO, misleading investors, as his article states, and they went on to get him for tax evasion. So yeah, he went on to mint new Pearl tokens for use, increasing their supply. He converted these tokens to other tokens in the marketplace, and then this scheme basically dropped the price. So that's what he did, and that's what they were angry about. But what they basically went on to get him for was tax evasion. So basically, in 2017, he filed a return with only $15,000 in income on it. And then in 2018, he started claiming a large amount of expenses. So, he purchased multiple yachts, a significant increase in a carbon fiber composite company, extensive spending at his home improvement store. He bought 2 homes, and put one in the title of his shell name. But in 2017, he only claimed $15,000 of income. So there's apparently some improprieties there. And then he claimed, so basically, based off of this, he only claimed 15,000 in income, but he's out buying yachts, he's out buying homes, and all these things. So this led to the IRS investigating him for tax purposes, and the tax loss that the IRS is saying they resulted from his actions amounted to $5.5 million. So he's going to be spending 4 years in prison, with probably additional repercussions on top of that, based off of the tax side of things. So it's interesting to see they sort of took an Al Capone approach with this guy, and they got him on tax evasion. I'd like to see in the future how common that's going to be. So we'll see if we continue to get more tax evasion related headlines here as the regulatory landscape heats up, and we start to see more action starting to come from the IRS and other taxing agencies. So sort of on that same token here, the next headline is J5 countries host a cyber challenge focused on data mining and financial reporting. So the J5 stands for the Joint Chiefs of Global Tax Enforcement. Now, I've been covering the J5 since it was formed years ago. I would have to look back to see exactly when they first put the J5 together. It was probably around 2017 or 2018. And really, it was formed to combat tax evasion through data sharing across countries and other methods, but data sharing being a very big one. And there was a heavy focus, and still is a heavy focus, in the J5 on cryptocurrency and on digital assets. So basically, recently, they got together and they hosted a cyber challenge where basically members of the J5 from different countries, from Canada, from the United States, from other countries. I'll probably list some of the countries in here. They hosted this cyber challenge. It includes experts from each country with the mission of optimizing the usage of data acquired from various open and investigative sources to each country. So basically, what they're doing at this challenge, and what the J5 does, is you see the IRS collecting information for years, and while they're doing that, other tax agencies around the world are doing the same thing. So the IRS most recently did their John Doe audit on Kraken, and Kraken's turning over their information on transactions from 2016 to 2020. So that is the type of information that the IRS, through this J5 agreement, will share with other countries as well, because they may have gotten information not just on US taxpayers, but on taxpayers within these countries, and vice versa. There may be an exchange that another country collected on, and that the Dutch collected on, and they turn that information over to US tax authorities, and it gives them more transactional data to use to enforce audits and to find people that are not claiming or underreporting their taxes. So it's another enforcement mechanism to where they're doing all of this data collection, but then they're also sharing it across countries to further bolster the data set that they have for a better chance at catching tax evaders. So that's what they were doing here. So let's see. So the challenges have proven to be fruitful for them in the past. They've caught multi-million-dollar Ponzi schemes with this, most notably BitClub that it mentions here. Um, let's see. I'm just seeing if there's anything else I want to hit on this. But, I think the big thing to highlight here is that this J5 has been in place for years. And, you sort of hear people say, the IRS doesn't understand cryptocurrency. They have been getting together with experts across the world for years, not only sharing data, but sharing tools and softwares and tactics and expertise in accounting for this data and identifying non-reporters. So these will continue, and the effectiveness by revenue agencies, including the IRS, to enforce cryptocurrency transactions will continue to improve as these collaborations continue to grow, as they continue to collect more data through their enforcement efforts and through new proposed regulations. We're going to continue to see this. So now this this is an interesting article. It's a funny headline. IRS raided by crypto investors as industry puts up fight against U.S. tax proposal. So this is the topic I've been covering. The proposal to establish a U.S. tax regime for digital assets has drawn a stunning 120,000 comments. So, I was tracking this from when it started with hundreds to a few thousand comments. I think I was reporting on here. Now it's up to 120,000 comments. So basically, these are on the proposed regulations, which are going to put very stringent tax reporting and data collection requirements on most decentralized exchanges and protocols. There's been a huge pushback in our industry on what these proposed regs cover and what they include in their definition as a broker, because it does include a lot of these decentralized exchanges. And they were using AI to draft many of these comments to the IRS, which is, part of the reason why we have such high volume here. So, the Internal Revenue Services did an audio only hearing today, and it's drawing views from the crypto industry on what threats digital asset advocates see embedded in the proposed new approach. So, some of the concerns include user privacy, the scope of the crypto entities that would have to report, like I was saying, the inclusion of stablecoins, and whether the proposal implies anything about whether digital assets should be counted as securities. So basically, people in our industry are arguing that this is an existential threat to investor privacy and decentralized crypto projects. So it's noted here this new taxation system won't become final until the IRS officials weigh the input and rewrite a final version and approve it. So We'll see if we get any revisions on this. Obviously, the definition of a broker is one of the biggest issues at hand here. And I think it's kind of interesting. I was saying this on a show I was on last night that, really what the regulators are focusing on in the definition of a broker is the degree to which these protocols and these decentralized exchanges are in fact decentralized. When you looked into this, you'll start to realize that there's not many protocols or exchanges out there that are 100% decentralized to where they don't have any control over the fees or front end websites or other aspects that lend to some level of decentralization. Most of them are functioning with the core protocol decentralized, but there's usually some layer of centralization at some aspect of whatever protocol it is that you're looking at. And that usually is going to, under the proposed regs, make them fall into this definition of a broker. So again, that's where the pushback is. What I would like to see in the final regs is them to, back off of that definition, away from these decentralized exchanges, and focus a lot of this more on centralized exchanges. I think they can focus the reporting on centralized exchanges and focus on clarifying a lot of the other tax issues at hand, rather than going for, such a large information collection. Right now, it's estimated, I've seen facts where these 1099 reporting requirements are going to increase the overall 1099s filed with the IRS to 8 billion, where now, not for DeFi, but for the whole country, there's only approximately 2 billion filed. So it's going to be increasing this by a multiple. And that's where the huge pushback comes, is the tax reporting burden it's going to place on these decentralized exchanges, most of which who probably won't comply with it. It will just lead to them geo-gating U.S. taxpayers out of it, so that then they don't have to comply with the requirements. Now, the issue with that is that there are similar international tax proposals that obviously are at different stages than this, but many of them are starting to focus on the same thing: information collection, decentralized exchanges. So, I think this is going to be an ongoing battle, but we'll see where it lands on these proposed broker regs after we've had this comment period and we've seen such a strong pushback in our industry. Let's see what, if any revisions we get on these final regulations. As you see here, it's quoted saying this would impose an unprecedented, unchecked, unlimited tracking of the daily lives of Americans. So, there's huge pushback on this. Federal agencies are compelled to review all comments in the process of giving birth to a new rule, and the incredible volume for this proposal could demand more time than usual to complete the task. So right now, these proposed regs were scheduled to partially go into effect in 2025 and then more so in 2026. And what's saying here is, due to the volume of comments and concerns raised and the process that Treasury has to follow, this could potentially delay things. So that is something that we'll watch very closely here. And there's other minor issues with all these that I'm not getting into, but the big one really is the broker reporting. And there's many other minor tax considerations that eventually I'll want to hit on, but the big one is the broker requirements. So one thing I recently posted about that I wanted to mention, and this is something that I'm also seeing at my practice a lot, is, the IRS information collection continues and continues. Most recently, they did an information demand to Kraken for 2016 through 2020. So this is going to be many tax years that Kraken has to turn over to the IRS. Upon hearing this, upon posting about this, I've already been having people reach out to me that have, neglected tax reporting for years and they know they were on Kraken. They didn't think Kraken was reporting to the IRS, and now they're realizing all of these transactions are going to get reported, and they have a tax problem on their hands. So, I'm getting tons of people reaching out to me, and what we're doing at Camuso CPA is working on getting all of their transactions from all centralized exchanges, all non-custodial wallets, and then accurately doing their accounting from their earliest transaction. If that's going all the way back to 2016, it's very common for us to go back, start in 2016, do all of the calculations going forward. If you're in this position where you're someone who hasn't reported and now you're hearing this news about Kraken, your best step is to get into compliance proactively, not to wait for a tax notice. So you want to be talking to someone like me, someone at Camuso CPA, where we can go back, we can do step number one, get your accounting in order, get all of your transactions, get them categorized, reconciled appropriately for tax purposes. Then we can get your accounting and we can compare it to what was reported for tax purposes. And then, yes, we're going to have to make the necessary tax amendments to make sure that we're accurately reporting this. This is going to put you in a much better position than getting a tax notice from the IRS or going under some form of audit as a result of underreporting or non-reporting. So it's just something I'm seeing a lot right now. Tons of people are reaching out. You would be surprised, maybe you'd be surprised by how many people are still, reporting crypto activity from 2016, 2017. And recently we saw the IRS put out information saying that based off of the data that they've collected from exchanges through John Doe audits and through other measures, they estimate a 75% non-compliance rate. So they still believe 3/4 of people are underreporting or not reporting at all based off of data that they get from places like Kraken. So I don't really see this slowing down anytime soon. The tax controversy related to cryptocurrency is something that's going to perpetuate well into the future here, unfortunately. But at Camuso CPA, we will be here, if and when you do need us to solve these issues. It's something that we've been doing for years, and we'll continue to do. So if you're worried about Kraken compliance, I suggest being proactive, having a conversation with an experienced crypto CPA that's is doing this all the time. And I've been seeing a ton of this lately, so you're not alone. Um, Next here, so I've been posting usually on a weekly basis. I've been trying to post a case study or just like a story or a write-up on different clients that we're serving at Camuso CPA and ways that they're helping them. We're starting to get a little bit of a sentiment change in the market. We'll see if it lasts, at least temporarily. We are a lot of talk about new bull markets. And the reason I bring that up is because in this particular client and case study that I wrote here, this is something that we really helped them out on. So in this client spotlight, this is about an NFT artist that first came to our firm during the last bull cycle. So, he's in the midst of a bull cycle, he's creating, digital artwork. Obviously, it's a bull cycle, it's an NFT bull cycle. The money's rolling in, Ethereum's going up, everything feels great for this guy. First, what he came to us for and what most people come to us for, and this is why I think this is a great example, is most people are going to come to us with multiple needs and we need to knock them out in a specific order that's logical and practical. So, the first thing that we had to help out this NFT artist with, and most people with, is you may have tax needs, you may have accounting needs, you may want to get a handle on your business. First thing we need to do is we need to get all of your accounting up to date. Usually that's going to involve some cleanup of any back accounting work, and this was no exception here. So we had to go back a couple years to all of the early trades, early transactions for both his company and his personal portfolios. We cleaned all that up and we got the accounting up to date through through his current year-to-date tax period. This gave us a clean cost basis information, a clean profit and loss statement and balance sheet for his company. We in that process set them up with a proper accounting system, a digital asset subledger and a general ledger system, so they're having a clear set of financial statements. That really is the first step, because if we're going to do anything from a tax perspective, anything from an accounting perspective, we need to know what's going on in your company. Therefore, we need accurate financial statements. So that's usually going to be our first step working with anyone, is getting your accounting cleaned up. But as it says here, we didn't stop there, because once your accounting is cleaned up, that's really the first step. We did a lot of tax planning with this client. I didn't go over all of the items that we helped them on tax planning. We were able to actually save them a lot of money in this case. I could probably do a different story on that, different case study on that. But what I was focused on here is one thing that through this tax planning process we addressed was treasury management, estimated taxes, and overall what he should be doing with his tax payments. And this brings me to, one thing that I see happen with people during every bull market is they'll make money in Ethereum or in another crypto asset. And we're in a bull market where it's up only. And because people are so emotions are so high, they're so ecstatic, they're just basically getting high off of this bull market. They think the prices are never going to go down. They just give into this hype, and they'll get paid in Ethereum, and they'll just hold the Ethereum, and they'll hold it right into a bear market. And what I try to avoid is there's two levels. There's the treasury management level of protecting your earnings and reallocating some of that into stables, into fiat. But even before that consideration, in terms of maintaining your profit, we want to just make sure that you're covered from a tax perspective. And what I see will happen is people will be earning in Ethereum and planning to pay their taxes out of Ethereum, but they'll leave their tax liabilities in Ethereum. A bear market will come, and then they'll be stuck paying their taxes out of Ethereum or another crypto asset that maybe dropped by 50%. I've seen so many people double their tax payments this way, where we flip from a bull to bear right before a tax season. They're paying their tax payment out of Ethereum. It dropped 50%. Now you're paying double in taxes, because you're going to have to liquidate that Ethereum at a low point just to pay the taxes. And psychologically, it usually hurts people to do that, because you're selling the bottom. It's a forced sale, and it's just extremely demoralizing. So we try to avoid that. And obviously it's something I'm constantly warning, when new people are coming into our firm, I'm constantly warning them about that during tax season. And that's what I did here with this client during the planning process. Now, here we are into the bear market. Now this happened much earlier into the bear market, but I was basically checking in with that client again, or I think we were actually in tax season at that point, preparing their return. And they were just thanking me because they heeded my advice. They moved out not only their tax liabilities, but a large portion of their actual earnings out of Ethereum and into stables. And it really protected their bottom line. And that really matters in these bear markets, where it starts to become a survival game for a lot of businesses, and you need runway and you need cash flow. So this is something to keep in mind as things start to heat up again, whether they start to heat up now, weeks from now, months from now. What goes up eventually comes down, and you don't want to be in a position where that's going to impact the taxes that you have to pay the IRS. So it's all about being proactive, having your accounting up to date so you understand your tax liabilities, doing tax projections so you can estimate what those are, and then making the right decisions with your finances. So I thought that was a good example, just because for every client that I've seen benefit from our advice and I've saved from making that mistake, I'll have several people come to our firm on a fresh new bear market and just, basically telling me that they made this mistake and being severely unhappy about it. And unfortunately, if time's already passed, there's not much I can really do to help you other than just do the accounting accurately and help you fix things going forward. So that's why I thought that was a good example. Keep an eye out for my LinkedIn. I'm posting a lot more case studies like that, and each one is going to sort of highlight some of these nuances and areas that I've helped people out, and help them avoid some pitfalls in this space that may apply to you now or in the future, or may apply to someone in your network or a client that you're working with. So that's a lot of what I wanted to cover today. There's a lot of moving pieces here with the proposed broker regulations and the headlines that we're seeing regarding tax enforcement. I expect that to continue to heat up in the future. And as we're moving into year end here as well, it's another reason why you, as a Web3 company, you as a digital asset investor, want to really make taxes and accounting top of mind for yourself, because year end is the time where, right now, with our clients at Camuso CPA, we're doing their accounting now, not during tax season. We're getting them up to date through year end so they can make investment decisions and they can make business decisions with a clean set of financial statements, so they have a true picture of their business, a true picture of their investment portfolio, and they're able to make decisions on loss harvesting, on estimated taxes, on what their plans are for next year given their current positions. And in addition to that, planning for taxes in terms of estimated payments, in terms of just making sure that you're not scrambling come January or February to try to meet the tax deadline. So really, right now, if you're a Web3 CEO, if you're a digital asset investor, top priority for you should be having your accounting up to date. That should already be up to date going into tax season. It will make your tax season that much smoother, and it can help you protect your bottom line in terms of being proactive with tax strategies, or just not making or overlooking issues before the tax year closes. So keep that in mind. Ask yourself this question: year end is here, holidays are right around the corner. Are you prepared for tax season, or are you basically just going to wait to be one of the many people that will be calling our firm a couple months from now after the holidays, scrambling for tax season? Whether you fall into either bucket, we can probably help you, but it's almost always better to be proactive. It's going to be better for your taxes. It's going to be better for your even mental perspective as well, to be proactive. So that's what we're working on a ton right now, is getting people up to date through year end, and or working with people that are having some of these back issues with Kraken and with other places, get into tax compliance. So if you fit any of those categories, if you're a Web3 business that needs year-end accounting, if you're a digital asset investor that wants to get your investment portfolio accounted for up to date for loss harvesting purposes, if you're someone that has been, transacting in digital assets for years and you've overlooked tax reporting, and now you're realizing the implications to that, and you want to get things in order with someone that has been through this before, contact me and my team at Camuso CPA, and I'd be happy to sit down, see exactly what issues that you're having within your business, within your portfolio, in your taxes and accounting, and we can work together to develop a plan of action to fix this for you, both to solve your short-term problems, but also any long-term issues as well, to make sure you have smooth sailing long into the future. So I appreciate everybody watching here today. Be sure to tune in next week. We'll have more updates because this space is moving so fast. But I thank you for joining the Financial Frontier. Until next time, I'm Patrick Camuso, signing off.